Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Friday, August 15th, 2025. Usually I do the podcast Saturday mornings, but I have something I have to do tomorrow. I'm going to be participating in a home run derby, and so I am going to be doing that, and I won't be able to do the podcast in the tomorrow morning. So I just decided to do it tonight. So it's early, one day early. So I hope you're doing well. I hope you had a good trading week. I hope you had a good week in general. And I appreciate you coming to my weekend review podcast. I hope you're going to learn something good today. So the format is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back, take a look at all the positions that I have. We'll talk about when I entered them, why I entered them, what the setup was, what the confluence of signals were, how I position size correctly, how I place my emergency stop, how I place my end of bar stop, how I take partial profits on the trade, and ultimately how I am going to exit the entire position if we reject significant overhead resistance levels. So I think it's a good way for you to understand my process, my thinking of how I look at trades, risk to reward, and the confluences that gets me into the trade in the first place. So we'll go through all the trades, the open trades, new trades, closed trades, and we'll see how I did. But I had a actually really good week, and I'm very grateful for that. After that, we are going to talk a little bit about trader psychology. Really, the most important skill is just the ability to create a plan and follow it. That's really what it is, and people have a difficult time doing that, some people. And the more you can follow your trade plan, the better trader you're going to be, the better results you're going to have. And don't we all want that? If we all want that, why don't we just follow our process, right? You may not have a process. Well, you can learn it from me. You can learn it from someone else. But the important part is wherever you learn the process, that you follow it. So I like to talk about trader psychology. It's always helpful for me to teach it. And hopefully at the same time, it's helpful for you to hear it. After that, I just finished going down through my master watch list, both on the daily timeframes and the weekly timeframes. And I have identified some potential trades for next week that are getting close to some major support levels and all other confluences of signals. They're not there yet. If they were already there, I probably would have already taken the trade. But, you know, there's a good chance next week that they can get there. And on Friday nights, tonight, when I go through these charts, I look, and really the main thought in my head is, you know, if I had my choice, like my preferred choice, where would I buy this when I look at the chart? I was like, well, you know, down there, you'd have a bullish order block, you'd have a 200-day moving average, that would dovetail with the 30 RSI. That's where I'd want to buy it. Well, that's essentially what I'm going to show you tonight. The location for me, ideally, that if it gets there next week, I have every reason in the world to potentially take the trade. If it doesn't get there, then I forget about it and I go on to the next one. But trust me, there's always ones that get there, right? Sometimes only one, sometimes a lot, and then you have to narrow those down. But so that's what I'm going to show you. Ideally for me, next week, these particular markets, where if they get there, where I would want to take the trade, and I will explain why. So hopefully that's going to be helpful for you as well. And so if you do find something helpful in the podcast today or tonight, I really would appreciate it if you could hit the thumbs up button. It really helps to build the channel, keep the channel around, lets YouTube know that there's some valuable content here. And so, yeah, if you could hit the thumbs up button, that'd be great. If you could subscribe, that would be wonderful as well. So let's go ahead and run this U.S. legal disclaimer, get that out of the way, and then we'll get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding on with me. I am babysitting my neighbor's 2 dogs, so if I get ambushed in the middle of the podcast with kisses, you will know why. And if you hear dogs barking, that's them as well. So let's go with the first open position that I have. It is Intel. I got long Intel way down here, really good price, $19.43 on the 4th of August. So why did I get long, right? What is the thinking? Well, you can see that there is this green box here. And the reason that I bought this was because on the day that I bought it, it went underneath the box and then closed back in it. So it was a rejection of the bottom of the box, or in other words, this is a rejection of the bottom of the order block. So order blocks are one of my favorite setups. I use these, I teach these to my students, but I use them with almost everything. And it's really something worth your while to learn. You can do so many things with it: trade stock, options, intraday. It's really great. But I'll take you back to why this is an order block. So if you go back here to the 23rd of May, you see that we have a swing low. We have a swing low that is then followed by a swing high that is then followed by another swing low that's lower than the first swing low. So swing low, swing high, lower swing low. And then the key here is that we have to take out that first swing high. And once we do that here, now that changes the structure of this trade from bearish to bullish. And as soon as you change to a bullish market structure, then I can identify the order block. And the order block is the lowest bar close before market structure change. So it's very well defined. So swing low, swing high, lower swing low. Here we take out the swing high. This puts us into a bullish market structure and also helps me define the order block. So the high and the low of this bar, because it's the lowest closed bar before market structure, becomes the order block. Now, when it breaks out of here, I don't buy. What I'm looking for is, now that it's broken out of that swing high, I'm looking for a pullback into the order block. Because in general, folks, when you change from a bullish market structure or bearish market structure to a bullish market structure, you generally want to buy the dips. It's the opposite with the short. If you change from a bullish market structure to a bearish market structure, you want to sell the rips or you want to sell the rallies. This is the opposite. We go from a bearish market structure to a bullish market structure, completely well defined with the order block. And I'm waiting for a pullback into this green area with the rejection of the high of the order block or the low of the order block or a moving average in the middle. I always like to point this out, here, July 10th, when it's up at $24. In hindsight, when you look back at that order block, was that a good place to buy? Clearly, it was a good place to buy. Could you say smart money was buying there? I think you could say that, right? In hindsight, when you're up here, you can look back and go, oh yeah, didn't look too bullish at the moment, but now that time has passed, yeah, smart money was probably buying there. So order blocks to me are smart money areas of support. So if I take this smart money area of support and I move it out into the future, if the price gets back into that smart money area, there's more of a chance it's going to bounce, because that's where the smart money was last time. Now, in the future, can this area, this was smart money. Does it have to be smart money the next time it comes here? No, definitely not. Things can change, right? Things can change with the economy, they can change with politics, so forth and so on. But as a general rule, this was a great place to buy last time. Is it a great place to buy this time? As long as the market tells me, the price action tells me that it is rejecting something, then yes. And so I bought here. Oh, sorry. No, it was the close below. It was the close below the order block and then the close back in. That was my signal. Excuse me. So the previous day it closed below the order block and then it closed back in. That is the primary signal. Rejection of the order block is a primary signal. In addition to that, we went under 30 RSI on this day to over 30 RSI the next day. That is a deep dip buy signal, right? I teach the deep dip buy to my private one-on-one clients. So this is a combination of two primary signals. This is a rejection of the bottom of the order block, primary signal. This is also a close under, close over 30 RSI, two primary signals. Now, does it guarantee that it's going to be a winning trade? Of course not. But what it has shown me is that it has rejected two major levels. So I enter here at $19.43. I position size based upon the volatility of the market, dividing 1% of my capital by the value of the 2 ATR. That shows me how many shares to buy. As soon as I enter, I place my emergency stop exactly 2 ATRs below. So that if it does go down there, I just did the math, if it does go down there, I lose 1% of my account. But I always have two stops. I have an emergency stop, which is 2 ATRs below my entry. And again, if it went down there, I would lose 1% of my account. However, that only happens about 5% of the time. The other 95% of the time, if I have a loss, it is going to be because it closed below my end of bar stop. What is my end of bar stop? Well, why did I take the trade? I took the trade because it closed under the order block and then rejected it and closed back in. My end of bar stop is just simply a close back below this order block, giving me a very good risk to reward ratio, right? Okay, so as soon as I enter the trade, so I have the trade, rejection of the bottom of the order block, the under 30 over 30. I have position size, place the emergency stop 2 ATRs below. Next thing I do, I place a trailing stop level 1.5 ATRs above my entry. This is the orange line. So I take my entry price plus 1.5. Right now, 1.5 is $1.45. And I just put it there. And if the price ever gets there, all that means is now I go into trailing stop mode. Doesn't mean I have to do anything at the moment. It just means I'm in trailing stop mode. If it never gets the 1.5 ATRs, then I just don't go in trailing stop mode. But it did. The very next day, I got to trailing stop mode. And all that means now is that in the future, if I have it closed below a previous bar's low, I'm going to get out of half of my shares. So everything I've talked about so far, the emergency stop, the end of bar stop, trailing stop level, these are all defensive moves. If something goes against my position, this is the action I take. But I also play offense in my trading. And I play offense in my trading by taking partial profits each day if the market moves a certain amount from the previous bar's close. And so I am still in this position, partly, and I'll show you what I'll do for Monday. All I do is I take the closing price of the day. Right now it's $24.56. I take $24.56. Then I look for the value of the 0.45 ATR. Right now it's 44 cents. So I take the closing price plus whatever the value of the 0.45 is on that day, 24.56 plus 0.44. My first profit target for Monday is $25 even. And if I hit that profit target, I will take off 10% of however many shares I went into the day with. So if I went into the day with 1,000 shares, I take 100 off there, right? 10% of however many shares you go into the day with. So my first profit target, closing price plus 44 cents is 25. I take my first profit target, 25, I just add it again, plus 0.44 My second profit target for Monday is 25.44. And again, if it gets to that level, I will sell 10% of however many shares I went into that day with. And then I do it one more time. I take the second profit target, 25.44, plus 0.44 again. My third profit target for Monday is 25.88. So I always place 3 profit targets every day. If the market's down on the day, maybe I don't hit any, right? Maybe it goes up in the morning, hits 1, and then reverses. Okay, fine. Maybe it keeps going up and hits 2. Great. I think I've hit 7 before, but I generally just put 3 because it's kind of hard to hit more than 3, but it certainly happens. So that's the offensive part, okay? So I'll run you through this trade now. We'll kind of, we'll go back and we'll kind of start over, but now we'll be able to flow a little bit. So I entered on the 4th of August at 1943. Why? 2 primary signals. A close under the order block, a close back in the order block. That's a primary rejection of the bottom of the order block. The second signal, price closed below 30 RSI the previous day. On the day that I took it, it closed above 30 RSI. Deep dip buy. So you have a primary deep dip buy, you have a primary order block. I position sized, entered at 1943. I placed my emergency stop 2 ATRs below. My end of bar stop is just a close below the low of the order block, and see how close we are to it anyway. Again, I placed my 1.5 ATR trailing stop level 1.5 ATRs above my entry, and away we go. So the next day, up very, very nice. I hit multiple profit targets on this day. Remember, I placed 3 every day. I think I hit 2. Could have hit 3. It was a while ago. I forgot now. And I also got to trailing stop level on the very next day. So now, again, what does that mean? It means that if I have a close below previous bar's low, I'm going to get out of half. Next bar doesn't do anything, no profit targets, no nothing. Here on the 7th of August, I have my first close below a previous bar's low. See how we closed below this low? After reaching trailing stop level, what do? I took off half of the shares that I had for a gain of 1.92%. Okay. But I kept the other half, thank goodness, because the next day, up. Next day, up big, multiple profit targets. Next day, up big, multiple profit targets. Next day, I can't remember if I hit a profit target here or not. Yesterday, huge up because of the news with the government and Intel. And then another multiple profit targets up here. Now, I sold half of the remaining shares at the end of the day. Why? Well, if you look at the RSI is 69.12. You can see earlier in the day we were way over 70. We were over 71, but it reversed. That is one of my rules to exit to the upside, is if you reject the high, if you reject the 70 RSI, however many shares I have left at that moment, I sell half. So I sold half here, and the remaining, let's see, here we go. And so I locked in a quarter, right? I had a half here, I took off half here, and I took half of a half, which is a quarter, for a gain of 20.85%. Now I still have a quarter left. And going forward, my rules are, if I get a close below previous bar's low, I'm just simply out of the trade. That's it. Or if it closes below the 5 EMA, this blue line here, I'm also out of the trade. Whichever one of those comes first. So, I've been trading for 30 years. I have many, many rules that I use for myself and that I teach my students. And this is one of the major ones. If you reject the 70 RSI, take off half. So I locked in half of the remaining position, a quarter of the original position, a gain of 20.85%. Again, based upon this very good risk to reward ratio with multiple primary signals. I didn't know this was going to happen. All I knew was if it closes below here, I just get out for a small loss. But this is a monster trade, right? This remaining the shares here at 20.85%. This pays for a lot of little losses that I'm inevitably going to have. Losses are okay. Taking small losses are fine. You can't predict anything. All you can do is structure your trade so that it's possible that you have a big trade, and it's very likely, if you're wrong, you'll have a small losing trade. Make sense? All right, so remaining shares up 20.85%. All right, let's go to Netflix. All right, excuse me, I have a little cough tonight. So I got into Netflix here on the 7th of August. Why? Rejection of the bottom of the green box, rejection of the bottom of the order block. I got long here, 1181. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below the low of the order block. Very close to it. Placed my trailing stop level 1.5 ATRs above, and then of course if it moves the value of 0.45 ATR, I take a profit target. Well, this moved more than 0.45 ATRs. I believe I hit 2 profit targets on this day, maybe 3. Taking profits into that strength. Also got to trailing stop level. Up again a little bit the next day, up again a little the next day. Here on the 13th, we had our first close below a previous bar's low. After reaching trailing stop level, I sold half of the remaining shares that I had for a gain of 1.93%. But I kept half. Next day, Thursday, up biggies. Hit multiple profit targets, selling into that strength. And then today, up again. So locked in half for a gain of 1.93%, and the remaining shares currently up 4.67%. So really good trade there too. INDA. Excuse me, sorry everybody. So I got long INDA here on the 11th of August at 52.28. So why did I get long on this trade? Well, we went under 30, over 30, and we had a bullish abandoned baby. And abandoned baby is when you gap down and then you gap up. That makes this is a bullish signal. But we also had an under 30, over 30, so I got long here 52.28. My end of bar stop is going to be a close under the 30 RSI. I placed my 1.5 ATR trailing stop level here, 52.19. Next day went up, enough for a profit target. Next day went up again, enough for a profit target. Have not got to trailing stop level. Then we had a pullback, but back up again today. Not yet at trailing stop. So the remaining shares that I have on INDA up 0.82%. But again, the signal, bullish, abandoned baby, under 30, over 30. If you'd like to learn more about abandoned babies and island reversals, go to my YouTube channel. I have a video there that describes why I take those trades and why they tend to work so well. So, yeah, remaining shares, INDA up 0.82%. All right, Adobe. Like to give a shout out to my student Vivek in Canada. He brought my attention to this trade. This is Adobe, ADBE, and I was looking for this trade on the weeklies, but I didn't see the trade on the dailies. And so he messaged me and he said, "Hey, Greg, did you see the rejection of the bottom of the order block in the V1 on Adobe?" And I said, "I did not. Let me take a look." Glad that I did, because I got long here on the 12th at 336.07. Why? Because this day went under the order block and then closed back in the order block. That's a rejection of the order block. On top of that, we also had a V1. A V1 consists of 2 bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. This is a V1 or V2 is a secondary signal. It's not enough just to get into the trade, but it gives supporting, it gives support to the primary trade. So the primary trade is the rejection of the bottom of the order block, and the secondary is the V1. Kitty, I have this dog trying to lick my hand. All right, so I got long here, 336.07. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block. I placed my 1.5 ATR trailing stop level above. Next day, took right off like a rocket ship, hit multiple profit targets, and now I'm in trailing stop mode. Next day, Thursday, not much, but today up nicely, right? Today up nicely again. And I did hit 2 profit targets today as well. So thanks to Vivek for pointing this out. Thanks, buddy. Appreciate that. And this has been a really nice trade. Remaining shares that I have up 5.28% on the rejection of the bottom of the order block and the V1 supporting. And we also rejected the negative third ATR channel here, which again, by itself is not an entry signal, it's a supportive signal. So the supportives were a V1 rejection of the negative third. The primary was rejection of the bottom of the order block, remaining shares up 5.28%. Okay, now UNG, and this is a good example of something. It's a good teachable moment. So, I've shown you 4 order block trades that did really well, and they do. In my experience, they win a lot more than they lose, but they don't always win. And I want to show you this. So on UNG, I bought UNG back here on July 31st at $13.51. Why? Rejection of the top of the order block. This is a blue order block this time. Rejection of the top of the order block, a V1, a rejection of the negative third ATR channel, super legit entry. I got long 1358, placed my emergency stop 2 ATRs below. My end of bar stop, just simply a close below the low of this blue order block. Went sideways, went down, but kept the stock up. Hit a profit target here, thankfully. Hit a profit target here, thankfully. And then just collapsed underneath the bottom of the order block. So I hit my emergency stop, right? Only happens about 5% of the time, but this was one of those times. And so this particular trade was a loss of 8.89%. Huge, right? But because I position sized correctly, for me, how much did I lose? 1%, right? Because my maximum allowed loss, my emergency stop is only going to be 1% of my account loss. So I took the trade. I can't control it. It was a loss. I followed my rules. Fine. No problem whatsoever. Now, I re-entered the trade yesterday on Thursday at $12.50. Why? Well, here we have a lower order block. And on Thursday, we went below the low of the order block, closed back in it, plus a V1, plus a rejection of the negative third ATR channel. So, I haven't even placed my trailing stop levels and all that kind of stuff yet, but hit multiple profit targets today. So this particular trade on the current one, currently up 2.65%, which is nice, right? It's good. But the reason I'm really brought this up is when you have a trade on a particular stock and it goes against you, in my experience, don't be afraid to take that trade again if you have another legitimate signal. Human nature being what it is, a lot of people, if they lose money on XYZ stock and they get a new signal, they don't want to take it again. They don't want to have, for whatever reason, they don't want to take another loss because they previous had a loss. And I think that's a mistake. So we're all going to have losses on good setups. And if you do have the loss, get out and take the loss. But then in the future, if you get another legitimate signal, don't go, well, it's legit, but I don't want to take another loss on this trade. I don't have that problem. I don't really look at it like that. If it's legitimate, I take it. Doesn't matter if I have 3 losses prior, I will still take the trade. And I did. And so this particular one currently up to what does that say, 6.5 or 8.5? 2.65%. So I'm glad I retook the trade. Okay, so those are all the dailies. Intel remaining shares up 20.85. Netflix remaining shares up 4.67. INDA remaining shares up 0.82. Adobe remaining shares up 5.28. The UNG had the loss of the big loss of 8.89%, but the new trade up 2.65%. So those are the dailies, and let us talk about the weeklies. I also like to trade on the weekly time frame as well. Weekly time frames close on Friday. So I bought UUP, which is the dollar, here on the 11th of July. Why? Two primary signals. First signal, close under, close over the 200-week moving average, right? The bar before closed under, then we closed over. Deep dip buy, primary signal. We also rejected the order block because the previous bar we closed in and then we closed above. So two primary signals, rejection of the 200 and a close under, close over the order block. So I got long 27.21. I position size using the 2 ATR. I placed my emergency stop 2 ATRs below. My end of bar stop on this one is just a close below the 200-week moving average. I placed my 1.5 ATR trailing stop level above, and away we go. Now I know exactly what I'm going to do regardless of what it does. If it goes way down, I'm going to hit my emergency stop. If it closes below the 200, I'm out. If it goes up big, I'm going to take some profits. If it gets up to my trailing stop level, I'm going to go into trailing stop mode. It's very important, everybody, that you have a plan for every single possibility that could happen. If then statements. If it does this, then I'm going to do that. If it does that, then I'm going to do this. So the next week after I bought, went up, hit a profit target. Next week, down. Next week, up big. Hit multiple profit targets, also got to trailing stop level, which was nice, right? Week after went down. Week after, also down. And we closed below the previous bar's low after reaching trailing stop level. And so I sold half of my position for a gain of 0.48%. I know that doesn't sound like a lot, but UUP is a currency, and so the percentages, they're just not big moves. But I still have half. If it keeps going up, I'll continue to take partial profits. Next week, if it goes down and closes below the 200, I'll simply be out of the trade. So UUP up 0.48%. XLV, if you've been watching this podcast for a while, you will know that, okay, I had to stop there for a minute and take care of the dogs, but XLV on the weekly. If you have been watching this program for the last few months, you will remember that I have been looking for this entry and waiting for this entry for over 3 months. I remember when XLV was up here. And I said, you know what? Where I want to buy XLV is way down here at the 300-week moving average because it is inside of this bullish order block. And I waited and I waited and I waited and I talked about it each week. It never got there. It never got there until last Friday. And last Friday, what did it do? It bounced exactly at the 300-week moving average, primary signal, and it also rejected the high of the green order block, primary signal. So that is why I took the trade. So I position size on the weekly, because this is weekly charts. I position size. I place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 300-week moving average. It's in the order block. I place my 1.5 ATR trailing stop level above. And as soon as I bought, I placed my 3 profit targets for the week. Well, look, big week up, hit 2 profit targets already. So it's a good example, everyone, of being patient and identifying the levels that you are looking for and waiting for them to get there. If you do this, your trading results are going to be improved. I promise you they are. And again, I talked about this for over 3 months. I didn't mess with it until it got to where I wanted it. And later in the podcast, when I show you the trades for next week, that's exactly what I'll be showing you. I'll be showing you exactly where I want these markets to get to. And if they get there, I'll consider taking the trade. If they don't, I won't. So anyway, really good week on XLV right off the bat. gain of 4.4%. Okay, let's go to TLT. I've been in this trade for months and months and months. I am really glad that TLT pays a dividend of 4% per year because I have been in this trade forever. I can't remember a trade I've been in this long. Weekly bars on TLT. I got in 117. I've been in since January. Why? Rejection of the high of the order block and a V1. I got long, 87.20. I placed my emergency stop, 2 ATRs below. My end of bar stop, closed below the low of the order block. Placed my trailing stop level, 1.5 ATRs above. Next week, nothing burger. Next week, nothing burger. Next week, up, hit some profit targets. Next week, really nothing. Next week, nothing. Nice big up bar here where I took partial profits and I also got to trailing stop level. Then we went sideways for 3 weeks, went down a little bit, and then we had then we had another big week up here where again I took profit targets, and I'm glad that I did because the next week we had a huge move down in bonds. We certainly closed below the previous bar's low after reaching trailing stop. I had to get out of half the position for a point. I think that says, yeah, 0.58% loss. Not a big loss. But again, you see how important it is that I took those profits while I had them. That's why I always take partial profits. So the next week went sideways. Then we had a week up where, again, luckily I hit some profit targets next week up. And then we moved down, down, down. We never closed below the low of the order block, so it kept me in my trade, just kind of moved sideways, didn't do anything. Luckily collecting dividends, right? Down. And now we've had a little bit of a move up here, but it's just really been a sideways motion. So the remaining shares on this particular trade are down. The remaining shares are down 1.17%. I'm looking forward to being out of this trade, and I'm sure you're tired of hearing about it too. I don't blame you. Okay, Amazon. So I did place an order today, a short position on Amazon just today. So why? Well, you see the red box up here. That is a order block, but this is a bearish order block. So what makes a bearish order block? The opposite of the bullish order block. We have a swing high, followed by a swing low, followed by a higher swing high, and then a market structure change. And once we change market structure to the downside, now I know where my bearish order block is. It is the high and the low of the highest up bar close before market structure change. So if and when it gets up to this order block, this is where I will be looking to short. And specifically, the reason that I took the trade was this week we rejected 233.70. So what's so important about 233.70? Well, if you go all the way back in time here, we had this big down bar. If you have a big down bar and you rally back to halfway of that big down bar, generally you will find some inherent resistance there. So I'm just trying to put the odds in my favor. So here's the big down bar. This week we rejected the big down bar by touching it during the week and closing under it. That's why it's a rejection. And it's inside of the bearish order block, right? So those are the two confluences. So I got short at 230.90. I placed my emergency stop 2 ATRs above me. My end of bar stop is simply a close over 233.70, the halfway of that big down bar, the red line, 233.70. It's really close, right? I'm doing what I'm supposed to do, placing my end of bar stop very close to my entry. So next week, if it just closes even 1 penny above there, it's fine. I take the small loss, I'm out. Worst case scenario, if it goes all the way up here, I lose 1%, right? It's unlikely to happen, but it could, so I need to have it there. So this trade is basically break even, but did want to show you this new short trade that I took on Friday. So The review recap on the weeklies, on the weekly trades, UUP up 0.48%, XLV up 4.4, the remaining shares up 4.4%, TLT remaining shares down 1.17%, and then the Amazon trade that I just showed you, which is basically even because I just took it. So let's talk a little bit about trader psychology, and then we will get on to the potential trades for next week. Okay, this is from Stephen Goldstein. You can follow Stephen at AlphaMind101. Very famous trader, very famous world famous trading coach. And they have a great podcast where they interview traders from the retail level all the way up to the hedge fund level, large financial institution traders. And I was very lucky to have been interviewed twice on Stephen's podcast. So if you want to listen to a good podcast about trading, check out Stephen at AlphaMind101 on X. So let's see what Stephen has to say today. Cutting losses, easy in theory, far more difficult in practice. The monetary hit is rarely the issue. Rather, it's the emotional hit to your ego and the shame and recollections of inadequacies this triggers. That's why the mind, not the market, is where the battle is. Boy, that's true, everyone. Usually the monetary, the financial hit really isn't the problem. In my experience dealing with traders and students and so forth, is that, excuse me, if they've had a run of losses, if you take another loss, you're just like, oh, I took another one. I must really be a really bad trader. And so if you don't take the loss, then you kind of don't have to take that hit to your ego, right? But it's not the right way to look at it. The best thing you can do is follow your process, get out of your trade. Maybe the next day it goes right back up. Yes, of course it happens. But if you're having a hard time taking your losses, think to yourself, reflect for a moment. Why am I having a hard time taking this? And normally it will circle back to your ego. And in my experience, you're going to have people that have had a string of losses are going to have a harder time taking their stop loss. If you have a string of wins, then you hit a stop loss, okay, pretty easy. Because it doesn't evoke that hit to your ego. But if you have multiple losses, and you're just like, I just don't want another loss, man. It's just reinforcing that I must be a bad trader. It's not that. But what's important, and if you want to keep trading in the future, you need to take that initial stop. It stings for a minute, but the first loss is the easiest loss. So if you are having issues with taking your stops, hopefully you can reflect on what we're talking about here. It's not so much the money as it is your hit to the ego. You have to let that ego go, just get out. And trust me, you're going to feel better that you did. You're going to have less stress when you just hit that button and it's done. Yeah, it'll sting for a minute. But anyway, the market is the arena, but the battleground is always inside your head. So again, for the millionth time, get yourself a process, learn a process, and then follow that process. All right, let's head over to the potential trades that I have for next week. Now, I always mention this before we start going down the list, but here on the daily, I have 7 potential signals for next week. Theoretically, all 7 of these symbols could trigger on the same day. Does that mean I would take all 7? No, I always only take 1 trade per day. If I have 7, I'm going to be able to narrow it down to the best one of the 7. How do I do that? I basically give each trade a score, a quality score. How many confluences of primary signals were there? How many confluences of secondary signals were there? What's the risk to reward look like? What's the relative strength of this market compared to the rest of the market? How does it look on a higher time frame? This is how I narrow this down. And this is what I teach to all of my students. And I've really seen my students excel really, really doing well because, I stay in touch with my students. I follow their trades. And by the way, if you would like to become a student of mine, I do offer a 20-hour course. It's a one-on-one course through Teams. And I teach you all 7 of the different trading approaches that I use. I teach you step by step. We do lots of simulation trades. It's a great course. It costs $2,000, right? So it's substantial. But what you're going to learn, the skills you're going to learn from investing $2,000, you can use the rest of your life. And I've taught people from all over the world, from absolute beginners all the way up to the hedge fund level. Right? I still work with hedge funds today, right? And everywhere in between. So if you want to learn a skill, if you want a good teacher that's had over 30 years of experience, and you want to learn a proper trading process that takes into account all the proper trading fundamentals of technical trading, I can teach that to you. I'd be happy to teach that to you. I know you're going to be glad. And so if you're interested, my email is in the link in the description. All you have to do is send me an email. I'll reply. We can set up just an initial kind of get to know you call, and you can ask me all the questions you have about the course and so forth, and we can kind of see if we're a good fit. But I would highly recommend it, and I will teach you everything that I know. And then, of course, I have the one-on-one, which I just talked about, the 20-hour course. But if you like video courses, I also have an online video course that teaches you the deep dip buy stock trading strategy, which we've talked about a little bit today. We've had some deep dip buy signals as well. That's at udemy.com. It's really good. It's 9.5 hours of video. Somewhere between $30 and $50 for the course, but I have sold so many of those around the world and got such good feedback, and that's a really, really good place to start. And so the link is in the YouTube description here if you are interested in that. So either the 20-hour one-on-one course with me, just send me an email, or if you want to start with the video course, just head over to the Udemy course. But I'd love to have you as a student, so please reach out. Okay, let's start with Boeing. Okay, so this is, you see red boxes here. Red box means that I'm looking for a short. Why is this a short? Okay, well, for a bearish order block, we need a swing high, which we have here. We need a swing low, which we have here. We need a higher swing high, which we have here. And then we need to take out the swing low. Boom, here we took it out. That changes from a bearish market structure into, from a bullish market structure into a bearish market structure. If you have a bearish market structure, I want to short rallies. Well, I was looking for a rejection of the low of the order block. That didn't happen. We closed in the order block. So what I'm looking for next week, very simply, is a rejection of the high of the order block. The high of the order block, here's the highest up bar close before market structure change. The high of the order block is 236.63. We're at 235.26. So next week, say Monday, for example, if we go above the high of the order block and then close back in the bearish order block, then we have had a rejection of the high of the order block. Depending on what the risk to reward ratio is, if it does that and goes all the way down here, then I won't take the trade. But if it goes above it, closes below, gives me a decent looking risk to reward ratio, yeah, I'll get short. Place my emergency stop 2 ATRs above. My end of bar stop will just simply be a close above this high, the high of 236.63. Place my 1.5 ATR trailing stop global, and because I'm short, if it goes down, I will take partial profits. So just to wrap it up, if I get a rejection of the high of 236.63, I will consider taking a short position on Boeing. Alibaba. Okay, interesting. Alibaba, I was telling you about abandoned babies earlier. Well, this is an abandoned baby, and a very distinct abandoned baby. What makes an abandoned baby? Well, look at the red box bar. The prior box, we gapped up. So, man, everything was exciting, was very, very bullish. We gapped up. But the very next day, we gapped down. So we went from very bullish to very bearish very quickly. And you see how this bar is just kind of hanging out here alone in space? That's why they call it an abandoned baby. So this is a bearish setup. But we have moved down quite a bit since this happened. So I'm not going to short here. What I'm waiting for is a rally back up and a rejection of the bottom of the abandoned baby. The bottom of the abandoned baby is 125.08. And this happens a lot with abandoned babies. You'll gap up, you gap down, then you'll have this kind of knee-jerk reaction up, but the real resistance level is the bottom of this baby. So if we reject the bottom of the baby and close below it, that is where I would get short. On these particular trades, these strictly abandoned baby trades, the way that I'll set this up is a little different than the rest of the trades. I'll put a 2 ATR stop above, a 4 ATR profit target below, and I'll just let it go. It's either going to hit 2 ATR stop where I lose 1% on my account, or it's going to hit 4 ATR profit targets where I make 2. And I'm not going to get into a trade unless the odds in my favor. But so if we do go up, reject the bottom of that order block, the odds are in my favor that it's going to head down. So that's where I can potentially make twice as much as where I'm risking. But sometimes you hit your 2 ATR emergency stop, right? I showed you on UNG, so it certainly happens. But that's what I'm waiting for on Alibaba, is rejection of the low of this order block, 125.08. Energy transfer. All right, so energy transfer is just a classic order block with the deep dip buy moving average in the middle. So here's your order block. We have a swing low, we have a swing high, we have a lower swing low. We change market structure to the upside. Once we change market structure to the upside, I can identify the order block. It's the lowest bar close before market structure change. The high and the low I've highlighted in green going forward. And right here, we have a 250-day moving average, a deep dip buy moving average, living inside the order block. This is my favorite trade in the world, everybody. When you have a major moving average inside a bullish order block, it gives you such a good risk to reward ratio. It gives you a definitive line in the sand. It gives you in an area where last time it bounced significantly from. So, if I could only trade one thing in the world, it would be this kind of trade. Now, we're not here. It's just like on XLV, exactly the same. But we're not here yet. So what I'm waiting for next week is if we go down, bounce at the 250-day moving average, intraday reject the 250-day moving average, or if it closes under, and then maybe the next day it closes back over, that would be close under, close over. So that is what I am waiting for. If it gets there, I will certainly consider taking the trade. If it doesn't, then I'll just let it go. But it has a possibility of getting there for sure. IBM. I want to say thank you to my student, Andre. Andre lives in Indonesia, and he, in one of his emails to me, he pointed this out. I usually don't follow IBM, but he asked me about IBM. When I looked at it, I was like, oh, man, that's really, really good. So that is why I'm highlighting it. And thank you very much, Andre, for that. And I guess I will see you Sunday night. We have our lesson on Sunday night. So IBM certainly was doing great and has had this big downfall. But look, we have a bullish order block here. What's inside of the bullish order block? The 300-day moving average. Again, my favorite setup. Major deep dip buy moving average inside of a bullish order block. And you might say, well, where's that order block from? Well, it's way back here. Where is it? Here we go. This is an order block 424.25. Swing low, swing high, lower swing low, market structure change. Wait till it comes back down. Well, it only took 4 months. And we're not even there yet, right? So we have to wait. We still have to wait and see if we're going to get there. But I know exactly where I want to buy IBM if it gets there. So again, the 300-day moving average inside the bullish order block, 226.40. We're at 239.72. So not there yet. May not get there. But if it does reject it, I'll certainly consider taking the trade. McDonald's. Okay, sneaky little order block. Swing low, swing high, lower swing low. Market structure change, high and the low of the, this is the lowest bar closed before market structure change. Well, look at the bottom of the order block. What do we have? We have a 200-day moving average. That's the black line. This is what I'm looking for. If McDonald's goes down, rejects that 200-day moving average, it will have happened inside a bullish order block, which drastically improves the chances for a trade. And that 200-day moving average gives you just a very nice definitive line in the sand. So looking for rejection next week on McDonald's. Tesla on the daily order block here. What makes it an order block? Here we go on the 24th of July, swing low, swing high, lower swing low, market structure change. As soon as it's changed market structure, lowest bar close before market structure gives me the high and the low of the order block. Draw that out into the future. Do I have any major moving averages inside there? I do. I have the 250-day moving average. That's the purple line inside. So if we come down, reject that 250, that's a potential trade. We also have the red line, which is the 100-day moving average, also living inside the order block. So either of those, I would consider taking the trade. Rejection of the 250, the purple, or rejection of the 100, which is the red. Now, of course, if it goes mowing down through those and then rejects the bottom of the order block, I could potentially get long there too, right? So just need to be patient. You know, Tesla's kind of crazy. It can go up, it can go down. So it certainly has a possibility of getting there. I don't know how likely it is, but if it does, those are the levels that I'm looking at. Okay, WES, Western Midstream. Talked about this last week. So this is a midstream petroleum company, pipelines. This pays about 11.5%. Pretty good yield on this. But again, we have an order block highlighted the high and the low, the green bars in this box. And we have three major moving averages inside of this order block, which dramatically increases the chance of it bouncing. So first stop is the 200-day moving average, the black line. That is the first potential moving average to base the trade off of. Below that, we have the 250-day moving average. That's also legitimate. Below that, we have the 300. So we have all three major moving averages, 200, 250, 300, inside the bullish order block. When they live inside the bullish order block, they are much more likely to respect those. And again, as I always say, it just gives you a good risk to reward ratio. So that's what I'm looking for on WES. All right, let's go over to the weeklies. I don't have a lot here. I only have three. Let's look at Lockheed Martin. Now, Lockheed Martin did exactly what it was supposed to do a month ago. Here's a bullish order block. Here is a 250-week moving average inside. It went and rejected it. Why did I not take the trade? And I have a student, Steve, that took the trade, so he's doing great. So good job, Steve. But the reason I didn't was because this bar was so big that rejected the 250. In general, I don't like big, huge skyscraper down bars to take my trades from because there's so much distribution going on in a big monster down bar like this that it's generally hard to rally from there. I'm surprised it's rallied as much as it has. Here we have the high, here we have the low. We got right to about halfway, which is about what I would expect. But what I'm looking for, and I hope this just keeps going up for Steve, but if it does come down, I would look for another rejection of the 250-week moving average, the purple line inside the bullish order block. You might say, well, it's the same place you could have bought it before. Yeah, but now we've had 3 weeks of kind of working stuff out, right? This was like a big rock in the water, huge explosion. You didn't really know what was going to happen. So, now we've had some buying and things have settled down. So, going down, rejecting the 250, I would certainly consider, if it was a good risk to reward ratio, getting long there. Or if you look at the bottom of the order block, we have the 300-week moving average. That would be my ideal spot to get in. So, but really, I can't predict. I don't know what the price action is going to be. If there was a V1, V2, something like that, it would improve. But just in general, next week, if we somehow reject the 250-week moving average with a good risk to reward, I'll consider that. Or if it goes lower to the 300, I'll consider that as well. Tesla. So I talked about Tesla on the daily, on the order block on the daily. We just talked about that. But if you look at Tesla on the weekly, we have a more significant weekly order block here on Tesla. Swing low, swing high, lower, swing low, market structure change. Inside this bullish order block, the bullish weekly order block, we have the 200-week moving average, the black line. This would be ideal if it comes. I mean, it's going to have to come down substantially, but if it does, for whatever reason, come down or reject that 200-week moving average, I would certainly consider taking the trade. Underneath that's the 250-week moving average. Certainly consider taking that. And then at the very bottom here, we have the 300-week moving average. Again, inside the bullish order block, I would certainly consider taking that there. And I realize it's unlikely it's going to come down. On the daily, is it likely? Yeah, it's a lot more likely that we could get here on the daily because it's easier to move on the daily. But this is a long ways on the weekly, but I like to have these things plotted out, planned out, so that if it does happen, I can go, oh, wow, that's what I was looking for. So rejection of the 200, 250, 300 inside the bullish order block on the weekly. And last but not least, XLE. Okay, I've been talking about this for a long time. We have a bullish order block here. The 200-week moving average, the black line, is at the bottom of the bullish order block. It's perfect, right? Doesn't mean if it goes down and rejects it, doesn't mean it has to work. But from a risk to reward ratio, being inside the bullish order block, rejecting the 200-week moving average, makes sense for me to take this trade if the risk to reward is good, because I just know even if it closes 1 penny below the 200-week moving average, I'm simply out, and that's it. Wait for your markets to get to significant support levels like order blocks, major moving averages. Get in if you have a good risk to reward ratio. If you're wrong, get out, most likely with a small loss. If you're right and it takes off like Intel did, then you have the potential for a big, big win. So I hope this was helpful for you to go over these trades and these potential upcoming trades. And if it was, like I said, if you could hit the thumbs up button, I would really appreciate it. If I can help you with your trading, if you are interested in me teaching you one-on-one, the 20-hour course, you're going to learn so much. I'd love to teach you. Reach out to me. Again, remember the Udemy course on the deep dip buy. You're really going to like that as well. But if I can help you in any way, consulting, private one-on-one consultations, I've been doing a lot of that lately. And I'm sure I can help you one way or another. And so I always like to leave off with, please try to go out and do something nice for somebody each day. If we all did one nice thing for another human each day, it would make the world a whole lot better place. If you could do one nice thing for an animal each day, they would love that. It's good karma, right? They appreciate acts of kindness just like we do. But God willing, I will see you next week. And I hope you enjoy your weekend. I hope I can hit a home run at the Home Run Derby. We'll see. I'll let you know. And if you have any comments or questions about anything I discussed, please put them in the comment section, and I will get back to you as soon as I can on those. All right. Thanks again for listening. Appreciate you investing the time. We'll talk to you later. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.